Hey everyone, it's Anthony Venuto with In Touch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, we're going to talk about 3 reasons why you want to consider choosing a variable rate mortgage over a fixed if you're going to be refinancing, purchasing, or even renewing your mortgage. Let's have a seat and talk a little bit more. Whether you're looking at a fixed rate mortgage or a variable rate mortgage, there are a lot of things to consider, and now more than ever, it is a little bit more of a challenging task for many people, especially for many Canadians looking to purchase, refinance, or basically even renew their mortgage. What option do they choose? In this video, I want to dive in a little bit more on why we at In Touch Mortgage Solutions would ask our clients or advise our clients to consider the variable rate mortgage depending on their scenario and depending where they are in the journey of their home ownership. So looking at some of the things that have happened in the news lately, as well as the global pandemic, we need to take into consideration where the Bank of Canada is in opposition to the rest of the global economy, and understand a little bit of a little couple things here and there that we would see as indicators of why choosing a variable rate mortgage may be more enticing. So first and foremost, on August 31st, we saw some news that the GDP contracted 1.2%. Now, what does that mean in the grand scheme of things? Well, we take that information and say, well, if we need to see a positive uptick in GDP and the performance of the economy, we need to see those numbers come up. And when the numbers contract, it is an indicator that the government will need to continue to provide stimulus and aid where it needs to be to help get the economy back and firing on all cylinders. So we might see variable rates and fixed rate mortgages stay low for a little bit longer than we originally anticipated. Now, obviously, that might be contrary to what we're seeing or hearing from the Bank of Canada and Tiff Macklem, but we need to take it into consideration and say what other indicators or what has history taught us. And once again, this is an opinion on what we see and how we think advising our clients properly, depending on their scenario, can help them save some money. So we're going to dive right into it, and I'm going to talk about 3 points of why you may want to consider taking on a variable rate mortgage. Number one, the most important and the biggest one, is the rate. The difference between the rates are actually staggering. It's usually anywhere from 50 to 60 basis points cheaper to go into a variable rate mortgage than it is to take a current fixed rate mortgage. Now, rates are all over the place depending on if you're in an insured mortgage, if you're in a conventional mortgage, depending on the lender that you're looking at. But having that option is going to put more money in your pocket. Simple calculation is if you had a $640,000 mortgage, and you're looking at a 25-year amortization. If you were to look at a fixed rate mortgage, you're looking at a payment of around $27.07 per month. If you were to take that exact same mortgage and put it on a variable rate at a 1.40%, you're looking at a payment of around $25.28.42 per month. I have to look at my sheet there for a second. So as you can see, that's about $178 savings per month between the fixed and the variable rate mortgage right off the hop. And that basically equates to a $2,100 savings over the course of 12 months. And that's about $10,000 of savings over the course of 5 years. As you can see, that's more money in your pocket to do as you wish. One other thing to consider in that rate is that the way interest and principal is calculated on the back end of your mortgage, the lower the rate, the more money goes towards principal than towards interest. So you're getting an additional savings and more money going towards your mortgage and as avoiding interest and going to principal than choosing a fixed rate mortgage at a slightly higher rate. Now, once again, having that conversation about whether you're choosing fixed or variable will come down to your particular appetite for risk, as well as the situation that you're in. Moving to option number 2, or reason number 2 why we would say consider a variable rate mortgage, is the penalty. Now, a lot of people don't look at the penalty, they look at the rate, and they don't understand the back end of what happens if they need to get out of that mortgage. And over the last year and 8 months, 9 months, we've seen that, when the pandemic first hit, a lot of people were a little bit jittery and locked into their mortgages, and then home prices started to go up and people maybe had thought about moving or refinancing their mortgage to pull out equity. And a lot of times what happened is that they had to pay a penalty to do so. Now, even if your mortgage is portable, depending on the scenario, you may need to get out of that mortgage or break that mortgage to touch it or to get money out or to move. So if you're selling the home, if you're going to refinance it, and let's say your mortgage is not portable, you're not eligible for that portability, you need to pay a penalty. The penalty on a fixed rate mortgage is interest rate differential, as opposed to a variable that's 3 months interest. Now, generally what we see as numbers and figures is penalties on fixed rate mortgages can be anywhere from $10,000 to $25,000, depending on where you are with that lender, who that lender is, and obviously what your contract states. Whereas a variable rate mortgage, you're at generally a 3-month penalty to get out, which can be anywhere from $1,500 to $2,500, depending, once again, on where you are in that mortgage. But it will always be cheaper to get out of a variable rate mortgage than it will be to get out of a fixed rate mortgage. Now, those are definitely some good points in the favor of choosing a variable rate mortgage. But option 3 on why you would consider a variable rate mortgage is looking at the flexibility and versatility of your mortgage itself. So depending on the type of variable rate mortgage that you're in or the fixed rate mortgage that you're in, looking at those penalties, looking at the ability for you to move out of that lender if you see fit, if you're going to sell the house, if you need to refinance, as we talked about in option 2 with the penalty, having that versatility to move out with the least amount of actual penalty can help you make your decision a little bit easier. If you need to refinance that mortgage, if you're looking to sell that home, it is always better to have a lesser penalty than it is to have a higher penalty, because it's money that you're spending just to pay off the bank for a penalty. One other important aspect when it comes to flexibility and versatility of choosing a variable rate mortgage is the fact that, let's say you're in the variable rate mortgage and you start to see that or feel that interest rates may go up. At any given time, you can go from a variable rate mortgage into a fixed. You can lock into whatever the lender is offering you at that specific time to lock in. It's not the rate that you're in, let's say the 1.40, it's whatever the lender is offering at that specific point in time. Now, with that information, what you can look at is to say, well, what is the rate that I would have paid, let's say the 1.99% as opposed to 1.4, and you could say, if I write out that mortgage for 3 years, I saved myself $6,000, and now the rate has gone up a little bit, you've offset that cost. However, what you need to consider is that if you're in a variable rate mortgage and you lock in, and depending on why you're locking in or how you're locking in that mortgage, is understanding the spread between the two rates. So when we look at the 1.99 to 1.40, you're seeing almost a difference of 60 basis points. Now, generally speaking, the Bank of Canada has increased and decreased rates usually by 0.25%. That is not a given that will happen in the future. But if we take that and what we see from history, that means the Bank of Canada would have to raise rates twice before you're even at even par with the exact mortgage that you would have taken at 1.99 and you jumped in at 1.40. So maybe staying variable a little bit longer might make sense, and you have that ability to lock in at any time if you see fit. Now, I hope you found this video helpful, and if you have any questions, as always, feel free to reach out to us at In Touch Mortgage Solutions. We're here to help. If you want to talk to us about your specific scenario and what you want to get some advice on it, always feel free to reach out to us as well. It's Friday. Thanks for tuning in. We wish you a great weekend ahead, and thank you for tuning in.